Welcome back to our exploration of the market matrix. In our previous videos, we've examined how markets function as a psychological game, the emotional patterns behind technical formations, the psychology of risk management, and the cyclical nature of market emotions. Today, we're diving into what might be the most challenging yet potentially rewarding approach to markets: contrarian investing. The core idea behind contrarian investing is deceptively simple. Do the opposite of what most market participants are doing. Buy when others are selling, sell when others are buying. As Warren Buffett famously advised, be fearful when others are greedy, and greedy when others are fearful. But if it's so simple, why isn't everyone doing it? Because it requires overcoming our most basic psychological programming. Humans are social creatures. Throughout our evolutionary history, following the group improved survival odds. This social instinct is deeply embedded in our psychology, making it extraordinarily difficult to stand apart from the crowd, especially during times of perceived danger. The market leverages this social instinct against us. When prices fall sharply, our brains interpret this as danger. Our instinct is to seek safety by following what others are doing, selling. Similarly, when we see others making money during bullish periods, our social instinct drives us to join in, often at precisely the wrong time. True contrarian investing requires recognizing and overriding these powerful psychological forces. It means training yourself to become comfortable with social discomfort, with being wrong in the short term, and facing criticism from others. Let's break down the psychology of effective contrarian investing and how to develop this rare but valuable skill. First, we need to understand what contrarian investing is not. It's not mindlessly doing the opposite of consensus. It's not taking positions against strong trends without evidence of potential reversal. And it's certainly not ignoring fundamental reality in favor of simply being different. True contrarian investing combines awareness of sentiment extremes with fundamental analysis. It looks for situations where emotional reactions have created significant disconnects between price and value. These disconnects create asymmetric opportunities, situations where potential reward far outweighs risk. The most profitable contrarian opportunities typically emerge at sentiment extremes. During times of maximum pessimism, even quality assets get sold indiscriminately. During times of maximum optimism, even questionable assets get bid up beyond reasonable valuation. These sentiment-driven mispricings eventually correct, creating opportunities for the prepared contrarian. So how do we identify these sentiment extremes? Several approaches can help. Sentiment indicators provide quantitative measures of market psychology. These include put-call ratios, which show the balance between bearish and bullish options activity. The VIX, which measures implied volatility and often spikes during fear. Surveys of investor sentiment, and fund flows, which reveal where investors are actually putting their money. These indicators often reach historical extremes near major market turning points. However, they're better at identifying potential opportunities than precise timing. Sentiment can remain extreme longer than you might expect. Media coverage offers another window into sentiment. Near market bottoms, headlines become overwhelmingly negative. Experts extrapolate recent declines into catastrophic scenarios. Every data point gets interpreted through a negative lens. Near market tops, the opposite occurs: relentless optimism, dismissal of warning signs, and justifications for why historical valuation measures no longer apply. The language used is particularly revealing. Words like crisis, collapse, and panic proliferate near bottoms. Words like new era, paradigm shift, and permanently higher signal potential tops. Capitulation events often mark sentiment extremes. These are moments of surrender, when previous holders abandon positions regardless of price due to emotional exhaustion. They're typically characterized by volume spikes, extreme price movements, and public expressions of giving up. These events frequently occur near major turning points and present opportunities for contrarians. Insider behavior provides valuable contrarian signals. When executives buy significant amounts of their own company's stock during pessimism, it often indicates undervaluation. Conversely, when multiple insiders sell during optimism, it might signal overvaluation. These individuals have the best understanding of their business realities, making their actions particularly informative. Valuation dislocations create the foundation for contrarian opportunities. During fear-driven sell-offs, valuations can reach levels that imply implausibly negative scenarios. During greed-driven rallies, valuations can reach levels that require unrealistic growth to justify. Contrarians look for these mathematical disconnects between price and reasonable value. Now let's discuss the psychological skills needed to act on these opportunities. The first is emotional independence, the ability to separate your thinking from prevailing sentiment. This requires cultivating awareness of how social consensus influences your perception. During market extremes, ask yourself, how is the prevailing narrative affecting my analysis? Would I reach the same conclusion in a different sentiment environment? The second is comfort with uncertainty. Contrarian positions rarely work immediately. Markets can remain irrational longer than expected, and contrarian positions often get worse before they get better. Accepting this uncertainty is essential for maintaining conviction during difficult periods. The third is patience. The time frame for contrarian opportunities is typically longer than traditional momentum-based approaches. You're not trying to catch the exact bottom or top, but rather to take advantage of significant mispricings that might take months or even years to fully correct. The fourth is selective exposure to information. During sentiment extremes, media becomes overwhelmingly one-sided. Limiting consumption of consensus views helps maintain independent thinking. Instead, focus on fundamental data and historical context rather than current interpretations. The fifth is appropriate position sizing. Because contrarian positions often move against you initially, proper sizing is crucial. Starting with smaller positions and adding as the thesis confirms allows participation while managing the psychological pressure of being temporarily wrong. To develop a practical contrarian approach, consider implementing these strategies. Create a sentiment dashboard that tracks various indicators. Look for convergence across multiple measures, which provides stronger evidence of sentiment extremes than any single indicator. Develop valuation frameworks for assets you follow. These provide objective reference points during emotional periods. Know what constitutes historical undervaluation or overvaluation in your investment universe. Maintain a contrarian watch list of quality assets that would become interesting at specific valuation levels. When market declines occur, this prepared list prevents panic and allows for rational decision-making amid chaos. Consider averaging into positions rather than trying to time exact bottoms or tops. This approach acknowledges the impossibility of perfect timing while still taking advantage of the opportunity. Use sentiment extremes as alerting mechanisms rather than exact timing signals. When indicators reach historical extremes, increase your research efforts and preparation, knowing that opportunities may soon emerge. Document your contrarian thesis in writing before taking positions. This creates a reference point that can be revisited during periods of doubt, helping maintain conviction when it's most difficult. Establish specific milestones that would validate or invalidate your thesis. This provides objectivity for evaluating positions rather than being swayed by short-term price movements. Let me share a perspective on contrarian thinking that has served me well over the years. I view market extremes as moments when narratives take precedence over mathematics. During pessimism, catastrophic scenarios get assigned inappropriately high probabilities. During optimism, growth scenarios get assigned unrealistically high certainty. The contrarian advantage comes from assessing probabilities more objectively than the crowd, not from knowing the future with certainty, but from better calibrating the range of possibilities when others have lost that calibration. For example, during extreme fear, markets might price a company as if bankruptcy is highly likely when objective analysis suggests it's actually a low probability outcome. The contrarian opportunity isn't betting on a specific future, but rather on a more balanced distribution of possibilities than what's currently priced in. Similarly, during extreme optimism, markets might price in perfect execution and growth with no possibility of competitive challenges or economic changes. The contrarian sees the wider range of possible outcomes when consensus has narrowed its vision. It's worth noting that contrarian investing is psychologically taxing. It requires comfort with being out of sync with prevailing opinion and often being wrong in the short term. few people have the temperament for a purely contrarian approach. A more sustainable approach for most is to maintain a generally balanced investment framework while allocating a portion of capital to contrarian opportunities when they present themselves. This creates the psychological space to act on mispricings without the constant stress of opposing market direction. Some of history's most successful investors, from Warren Buffett to Howard Marks to Michael Burry, have incorporated contrarian elements into their approach. They've demonstrated that betting against emotional extremes, while psychologically difficult, can generate substantial returns over time. Let me leave you with this thought. Market consensus isn't always wrong. Trends can persist longer than expected, but at emotional extremes, when fear or greed overrides rational analysis, the prepared contrarian finds opportunities that others miss. In the game within a game, the ability to maintain emotional independence while others get swept up in collective psychology might be the most valuable skill you can develop. It allows you to see the market reality beneath the prevailing narrative and position yourself accordingly. Before we wrap up, I want to invite you to join our trading community where we regularly identify and analyze these contrarian opportunities together. In our Discord, we provide AI-enhanced data that helps highlight sentiment extremes and valuation disconnects. Our consolidated resources help you develop the psychological skills needed for effective contrarian positioning. Whether you're looking to discuss potential contrarian opportunities with experienced traders, access our educational materials on sentiment analysis, or simply strengthen your ability to think independently of the crowd, I encourage you to join us. The link is in the description below. Remember, developing contrarian capabilities is challenging, but it's far easier when you're part of a community that supports this approach. Join us today and start building your contrarian edge. I look forward to seeing you there.